Hello friends, Victor here. In this video, I'm going to analyze Meta stock. I will explain why I'm buying more Meta and more importantly, why I believe Meta is likely oversold or undervalued right now. To give you some context, Meta stock recently dropped as much as 11% after its latest earnings announcement. The main reason is that Meta plans to significantly increase its AI spending in 2026 to prepare for superintelligence. Investors are concerned that Meta might be overspending on AI, similar to its massive metaverse investments that continue to lose tens of billions of dollars every year. Now, during the latest earnings call, Mark Zuckerberg said that he wants Meta to become a leading frontier AI lab. Zuckerberg knows that Meta is still well behind other AI labs such as OpenAI, Google, and XAI. He also emphasized that Meta's goal is to build personal superintelligence for everyone and to deliver superintelligence to billions of people around the world. Now, to achieve this, Meta will need to invest much more in AI data centers over the coming years. Zuckerberg mentioned that he wants Meta to aggressively front-load its AI investment so that the company will be ready for the best case scenario where superintelligence may even arrive in around 5 or 7 years or slightly longer. Meta is currently planning to build at least 7 gigawatts of AI data centers over the next 5 years. Building AI infrastructure at this scale is extremely expensive. Each gigawatt of AI data center capacity typically costs around 50 to 60 billion US dollars. This means Meta could end up investing 350 billion or more in AI infrastructure over the next 5 years. The key question is, how will Meta fund all of these massive AI infrastructure projects? Historically, Meta funded its capex using its large operating cash flow each year. But in recent months, Meta has started issuing more debt and using off-balance sheet external financing in partnership with other firms to fund its AI build-outs. Of course, investors are not happy about this new debt financing and off-balance sheet external financing. All of this spending will impact Meta's margins and free cash flow at least throughout 2026 or possibly even longer. So in this video, I'm going to explain why I'm still buying more Meta stock, even though Meta is likely overspending on AI infrastructure and won't see high returns on these investments right away. I'll also explain why I believe Meta is likely oversold or undervalued right now. If you enjoyed this video, make sure to hit the like button, subscribe, and turn on notifications. I will continue making high-quality investing videos every week that will help you become a great investor. Each video usually takes me more than 30 hours to make, so if you'd like to support the channel, check out my Patreon in the video description. Our goal is to help our members become multi-millionaires through intelligent investing. As a premium member, you'll be able to follow all my latest stock trades and portfolio rebalancing. You'll get access to my intrinsic valuation models for all the stocks I'm analyzing, so you'll know when a stock becomes undervalued, fairly valued, or overvalued. On top of that, you'll receive my latest stock ratings, exclusive premium content, and access to our Patreon-only intelligent investor Discord community. All the links to my Patreon and my X account are in the video description. Make sure to check them out. Before we dive into Meta's biggest risk and headwinds, let's take a look at how the company is doing financially right now. Meta's core advertising business is actually doing really well, even though there's been a lot of concern about the company overspending on AI infrastructure over the next few years. In the most recent quarter, Meta's revenue grew 26% year over year, which is outstanding for a company this size. Its operating margin dipped just slightly to around 40%, which is still very strong when you consider Meta's massive revenue base. Now, you might have seen that Meta's net income and EPS dropped quite a bit year over year, but that's mostly because of a one-time non-cash income tax charge of about 15.9 billion. Here's the thing, this charge was an accounting adjustment and not a real cash outflow. It happened because of the implementation of Donald Trump's One Big Beautiful Bill. So it's not something we should worry about. In fact, management said that Meta's actual tax payments will likely be lower going forward. Let's take a look at the rest of the numbers. Daily active users across Meta's family of apps hit 3.54 billion, up 8% year over year. Ad impressions rose 14% year over year, and average price per ad increased 10% year over year. These results are outstanding. They show that Meta's core advertising and social media business is still the best in the industry. Meta also has a very strong balance sheet. At the time of making this video, Meta has about $44.5 billion in cash and marketable securities, versus around $51 billion in total debt and operating lease liabilities. So even if Meta were to pay off everything tomorrow, it would only have $6.6 billion in net debt left. This is tiny compared to Meta's $40 billion plus in free cash flow every year. Now here's the important part you should know. Management gave this updated guidance, saying that both operating expenses and capex are going to increase by a lot between now and 2026. Basically, Meta wants to fund its AI investments, spending heavily now to build out personal superintelligence for billions of users. Management said this: we expect full year 2025 total expenses to be in the range of 116 to 118 billion, updated from our prior outlook of 114 to 118 billion, and reflecting a growth rate of 22% to 24% year over year. We currently expect 2025 capital expenditures, including principal payments on finance leases, to be in the range of 70 to 72 billion, increased from our prior outlook of 66 to 72 billion. As we have begun to plan for next year, it has become clear that our compute needs have continued to expand meaningfully, including versus our expectations last quarter. We are still working through our capacity plans for next year, but we expect to invest aggressively to meet these needs both by building our own infrastructure and contracting with third-party cloud providers. We anticipate this will provide further upward pressure on our capital expenditures and expense plans next year. As a result, our current expectation is that capital expenditures dollar growth will be notably larger in 2026 than 2025. We also anticipate total expenses will grow at a significantly faster percentage rate in 2026 than 2025, with growth driven primarily by infrastructure costs, including incremental cloud expenses and depreciation. Employee compensation costs will be the second largest contributor to growth, as we recognize a full year of compensation for employees hired throughout 2025, particularly AI talent, and add technical talent in priority areas. Now let's talk about Meta's biggest risk and headwinds. Realistically, since Meta plans to fund slow AI capex aggressively, its margins and free cash flow will likely be much lower through 2026 and possibly longer. Meta plans to build at least 7 gigawatts of compute capacity over the next 5 years. The Prometheus project, which is about 1 gigawatt, should come online in 2026. The Hyperion project, which is up to 5 gigawatts, will come online gradually after that. The El Paso, which is another 1 gigawatt project, is expected to be completed by 2028. To put that into perspective, each gigawatt scale AI data center costs around $50 to $60 billion to build. So 7 gigawatts of AI infrastructure means at least $350 billion in total capex. Of course, Meta doesn't want to use all its cash flow to fund its AI infrastructure build-outs, so Meta is planning to use more debt and external financing going forward. For example, according to Reuters, Meta is raising funds through a 6-part bond sale with maturities ranging from 5 to 40 years. Meta last tapped the bond market in 2022 with a $10 billion sale. Last week, Meta struck a $27 billion financing deal with Blue Owl Capital, Meta's largest ever private capital agreement to fund its biggest data center project, known as Hyperion. Major tech companies including Alphabet, Amazon, Meta, Microsoft, and CoreWeave are on track to spend $400 billion on AI infrastructure this year. Of course, Meta is not the only company that's building gigawatt-scale AI data centers. Other hyperscalers like Google, Amazon, Microsoft, and Oracle are all spending tens of billions of dollars to build their AI data centers every quarter. Meta is impacted much more than others because, unlike other hyperscalers, Meta does not rent out its compute capacity to external customers to earn cloud revenue. Instead, About 98% of Meta's total revenue still comes from ads on its social media platforms. That's why many investors worry that Meta is overspending on AI without seeing return on AI investments right away. Here's my prediction. I think Meta will have two extreme scenarios, a worst case scenario and a best case scenario. Let's start with the worst case scenario, where Meta ends up overspending on AI infrastructure. First, just like it has done in the past, Meta will eventually cut operating expenses and slow down its large capex growth and AI infrastructure build-outs over time. This will help increase the company's operating margins and free cash flow growth significantly. Second, most investors do not know this. Meta's AI infrastructure is very flexible. It can be repurposed for many different use cases. So if Meta does overspend on AI build-outs, it can redirect that computing power to improve its core advertising and social media platforms. Right now, both Meta's core advertising business and its super intelligence lab business are compute constrained, meaning that they don't have enough computing power to support both businesses. Even if the super intelligence lab fails, Meta can still use its massive compute capacity to improve content recommendations for billions of users and improve ad targeting and ad performance for advertisers. Third, if Meta ends up with too much AI computing capacity, it can always rent out that extra capacity to external customers to earn cloud revenue, just like Google Cloud, Amazon Web Services, Microsoft Azure, and Oracle Cloud. Now let's consider the best case scenario. If Mark Zuckerberg is right, overspending on AI builds now should help Meta achieve AGI or even super intelligence much faster within the next 5 to 10 years. In that case, Meta will eventually become one of the leading AI frontier labs that can compete with OpenAI, Google DeepMind, xAI, and Anthropic, and start earning meaningful revenue from its AI services. And if Meta achieves AGI, or better, artificial super intelligence, it will be able to monetize its AI services very quickly because Meta already has over 3.5 billion daily active users across Facebook, Instagram, WhatsApp, Meta AI, and other social apps. Of course, the market is worried that Meta might be overspending, just like it did with the Metaverse business. But I'm not worried about it because Meta can always slow down its capex later on, redirect its AI compute to improve its core advertising business, or even rent out any extra compute capacity to external customers, just like other hyperscalers. Now, I want to show you Meta's recent financials before we talk about its long-term growth prospects. As I mentioned earlier, Meta's core business is still performing exceptionally well, even though the company is likely overspending on AI infrastructure right now. For example, at the time of making this video, Meta's trailing 12-month TTM gross margin is around 82%. Its operating margin is around 43%, and its free cash flow margin is roughly 24%. All of these margins are very strong. On top of that, Meta's return on assets is around 19%. Return on equity is around 31%, and return on invested capital is roughly 21%. All of these financial ratios are also very strong. Over the past 5 years, Meta has delivered fairly consistent growth in both revenue and operating income almost every quarter. But back in 2022 and early 2023, you can see that Meta's growth slowed down by quite a bit, mainly because of Apple's app tracking option. Apple's app tracking option requires apps to ask users for permission to track their activities across other apps and websites. Of course, most people opt out of app tracking because they didn't want companies like Meta collecting their user data and behaviors on other platforms. This had a huge impact on Meta's advertising business back in 2022 and early 2023 because Meta could no longer rely on Apple's third-party tracking data to deliver more personalized ads. So starting in late 2021 and early 2022, Meta began investing heavily in AI models and large clusters of NVIDIA GPUs to rebuild its ad targeting and content recommendation systems. This time powered by Meta's first-party data and internal AIs instead of relying on Apple's third-party tracking data. Fast forward to today, you can clearly see the results. Meta's revenue and operating income have grown significantly since 2022, largely because of those massive investments in NVIDIA GPUs and Meta's AI-driven recommender and ad targeting systems. During that same period, Meta's operating cash flow and free cash flow also dropped sharply in 2022 and early 2023. That's because Meta had to increase its capex to buy a lot more AI GPUs from NVIDIA and build AI systems that will improve Meta's ad targeting and content recommender systems. Right now, Meta is once again in a major capex growth phase. Meta is planning to build at least 7 gigawatts of AI data centers over the next 5 years. Eventually, I expect Meta will slow down its AI spending to a more reasonable level. When that happens, Meta's free cash flow and margins will eventually return to normal, just like they did in the past. Now let's talk about Meta's long-term growth prospects and its expected growth rates over the next 5 years. First, according to this consensus forecast, Meta's revenue is expected to grow by as much as 21% year-over-year this year. After that, Meta's revenue growth is projected to stay in the mid to high teens annually over the next 5 years. However, Meta's EPS will likely grow slower than its revenue growth over the next 5 years, mainly because of the company's massive investments in AI talent and AI infrastructure build-outs over the next 5 years. That said, it's essential for Meta to invest aggressively in AI right now. Meta wants to stay competitive, not just in its core business, but also in developing frontier AI models. Meta doesn't want to be behind in the current AI arms race. If Meta falls behind in AI, it will be very hard to catch up to other major competitors like Google, Apple, OpenAI, TikTok, Anthropic, and XAI. I've said this several times in my previous videos. Meta's social media and advertising business will continue to be its biggest growth driver and the main source of revenue in the coming years. As of now, advertising still accounts for about 98% of Meta's total revenue and 100% of its operating income every quarter. In comparison, Meta's Reality Labs or its Metaverse business is still losing billions of dollars every quarter. Mark Zuckerberg has made it clear that he wants to replace the iPhone. He is essentially betting that mixed reality headsets and affordable AI glasses will eventually become the next major computing platform after the iPhone. Personally, I'm not betting on Meta's Metaverse business. I think it's extremely hard to compete with Apple's walled garden iOS ecosystem and Apple's iPhones that are already used by billions of people around the world. Realistically, social media apps, advertising, and now AI-generated content will continue to drive most of Meta's revenue growth in the coming years. Meta has a huge competitive moat known as network effect that is nearly impossible for competitors to copy. At the time of making this video, Meta already has over 3.5 billion in daily active users across its social media apps including Facebook, Instagram, Messenger, WhatsApp, Threads, and Meta AI with Vibes. Meta's daily active users will continue to grow steadily over time because of its large network effects. Meta's social apps such as Facebook, Instagram, WhatsApp, and Messenger will keep attracting more users because almost everyone uses at least one of these apps every day. It's nearly impossible not to use Meta social apps. As more people use Meta social apps, more of their friends, families, and colleagues join too, share more posts, photos, and videos, which will drive even more engagement. All that engagement generates very valuable data that feeds into Meta's AI recommender systems. Based on everything we post and watch across Meta social apps, Meta has a deep understanding of each user's interests, hobbies, and the things we like and dislike. Meta can then use this first-party data to improve its AI recommender systems and ad targeting systems, which leads to even higher engagement, better content recommendation, and more relevant ads for users. On the other side, advertisers will continue to increase their ad budgets on Meta's platforms because Meta has the largest daily active user base in the world. As Meta's AI systems get smarter, ads become much more targeted and more effective, and of course, higher ROI for advertisers. This creates a very powerful feedback loop for both users and advertisers. Ultimately, Meta's powerful network effects and data flywheel will keep fueling user growth, much better content recommendations, stronger user engagement, higher return on investments for advertisers, and higher ad revenue for Meta for many years. Going forward, we're going to see a lot more AI-generated content, such as AI short-form videos like Sora videos, where users can simply prompt the AI and ask the AI to create the video they want. I believe this will be a huge opportunity for Meta that will drive even more user engagement, social media content, and eventually more ad revenue. This is why Meta is investing aggressively to build at least 7 gigawatts of AI data centers over the next 5 years. Right now, Meta is still compute constrained, but once it has more AI capacity, I believe it will make its AI features like Meta AI with Vibes much more accessible and easier to use for billions of users around the world. And of course, this will only strengthen Meta's large network effects and data flywheel even further. Here, you can see that Meta's average revenue per user has been increasing gradually almost every quarter. This is a very important metric because it shows that Meta isn't just attracting more users, it's also earning higher ad revenue from each user quarter after quarter. Moreover, Meta's ad impressions have also been increasing almost every quarter. This tells us that Meta's ad targeting systems have been improving and are now delivering more relevant ads to users. If you look at Meta's average price per ad, you will notice that it has been increasing steadily, often by high single digits or sometimes even double digits every quarter. That's a huge improvement because it shows that Meta's ads are becoming more effective, driving higher ROIs for advertisers, and that's why advertisers are willing to spend more on Meta's ad platforms. All of these metrics show that Meta's network effects, data flywheel, AI recommender systems, and ad targeting algorithms are getting stronger every quarter. So contrary to what many investors might think, Meta has already been earning high returns on its AI investments in its core advertising business since 2022. Looking ahead, I believe Meta will continue earning much higher advertising revenue in the coming years because of its massive network effects and data flywheel, ongoing investments in AI infrastructure, frontier AI models, AI recommender systems, and ad targeting systems. At the time of making this video, Meta's Llama 4 model is still quite behind the frontier models from OpenAI, xAI, Anthropic, and Google DeepMind. But as I mentioned earlier, Mark Zuckerberg is willing to invest aggressively and front-load Meta's AI spending to build personal superintelligence for billions of users around the world. He knows that Meta has to stay competitive in the current AI arms race. If Meta succeeds in developing AGI, or even better, artificial superintelligence or ASI within the next 5 to 10 years, Meta will have many new revenue streams and be worth much more in the long run. And if Meta fails to build AGI or ASI, Meta can always scale back its AI investments and reduce capex over the next several years, which will improve its margins and free cash flow. Meta can also redirect its AI systems to improve its core social media and advertising business, which already generates 98% of the company's total revenue and 100% of its operating income. That's why I'm not worried about Meta overspending on AI infrastructure between now and 2026 or even beyond that. Meta has a very strong social media business and strong free cash flow to support its massive AI spending over the next few years. Now let's go over Meta stock valuation. There are many ways to value Meta stock, but the easiest way is to look at Meta's 4P ratios compared to its expected growth rates over the next 3 years. Right now, I believe Meta is undervalued based on its 4Ps and its expected EPS growth rates over the next few years. For example, at the time of making this video, Meta's 4P is expected to be around 24 for this year, 21 for next year, and slightly below 20 after that. Meta's 4Ps are too low compared to its expected EPS growth of low to mid-teens per year over the next 3 years. In fact, Meta currently trades at a much lower 4P than many non-tech companies in the S&P 500 that are growing much slower than Meta. I always use this evaluation tool before deciding to invest in a high-quality company. Typically, I prefer to buy only when the stock trades below its fair value because it will greatly reduce the downside risk. We'll be releasing this investing app later this year once we finish registering our company. In this chart, the blue line is Meta stock price, the orange line is Meta's fair value over time, and the dotted lines are the price targets. At the time of making this video, Meta has recently dropped well below its fair value, which I believe should be around $775 per share. This means Meta is likely significantly undervalued now. I also calculated Meta's intrinsic value manually using this intrinsic valuation model. If you'd like to access this model, you can download it from my Patreon blog. The link is in the video description. Since this video is getting long, I will just give you a quick summary here. Based on my calculations, I estimate Meta's intrinsic value to be around $680 per share. For comparison, Morningstar estimates Meta's fair value at around $850 per share, while our investing app estimates it at around $775 per share. Taking the average, Meta's average fair value should be around $769 per share. This means I believe Meta stock is likely oversold and undervalued now. So will I buy Meta stock? My answer is absolutely yes. I actually doubled my Meta position in this account recently after the recent large dip. I also have Meta stock in other accounts that I bought much earlier. I believe Meta is greatly undervalued based on its long-term growth prospects and the stock valuations I showed you earlier. The important thing to understand is that Meta's core advertising and social media business remains exceptionally strong. Meta's strong fundamentals have not changed at all. Meta will continue generating higher advertising value and operating income over the next 5 years. Because of its massive network effects, data flywheel, and huge investments in AI infrastructure, AI models, AI recommender systems, and ad targeting systems. If Mark Zuckerberg realizes that Meta has been overspending on AI infrastructure, Meta can always slow down its capex later on and redirect its AI compute capacity towards core business. Doing that will improve Meta's margins and free cash flow. On the other hand, if Meta actually succeeds in building AGI or even personal superintelligence much faster, it will unlock many new revenue streams and Meta will be worth much more in the long run. This is why I'm not worried about Meta's overspending on AI infrastructure now, even though it will temporarily impact its margins and free cash flow at least throughout 2026 or even longer. I believe this is just a short-term headwind for Meta. Now, everything I've shared here is just my opinion based on my own research and analysis. This content is for informational and educational purposes only. It is not financial advice. There are always risks in investing, so it's important to invest in what you know and not speculate. Always do your own research and thorough due diligence first before making any investment decisions. Thank you for watching and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.